This was predictable from day one back in 1971 when we got rid of the last vestiges of the gold standard. And it took a really long time to get here, but we have arrived at this really predictable place where the Fed's in a box, its tools don't work anymore. Nobody trusts the other guys who are in charge, and politics are becoming kind of warfare by another name. So we're on the verge of a civil war in a lot of aspects in the U.S. and in a lot.
You're watching Silver News Daily. Subscribe for more. Silver is breaking its 11-year all-time high, and the future looks even brighter. According to John Rubino, silver is set to skyrocket to an incredible $3,000. This astonishing prediction comes at a time when silver is trading at just $29.60. So how can silver possibly reach such heights? Stay tuned to find out why the age of silver is upon us, and how this could be your opportunity to benefit from an unprecedented surge in silver prices.
Well, it's really important to understand that the Fed is totally clueless. Remember 2 years ago, inflation was transitory. And then it was not quite transitory, but it's still going to go away. And then, 3 or 4% inflation is not that bad after all. And pretty soon it's going to be 3 or 4% is our new target, and that's because they're working with flawed models. They really never understood basic economics to begin with. They're just guys who got political appointments, or economists who got theoretical degrees in economics, which really don't do you any good in the real world. So they're going to flail around. That's the short answer to your question. They're going to do things that in retrospect look kind of stupid, but in the moment is the best they can come up with. And it's going to be skewed towards easy money because that's the real tool that they've spent their careers finding success using in a credit supercycle. But I think it's arguable that we're leaving this credit supercycle that started in 1971 when we went off the gold standard and entering something that's a lot darker. So the Fed, think of the Fed as kind of those Mr. Market stock traders who are now in buy the dip mode. They've got the idea that they can fix things with easy money because it's always worked in the past. Decent chance it doesn't work this time. And that's where things get really interesting. When the old models are proven false, the old tools are proven ineffective, and things get very, very tumultuous. And I think that's how we'll come out of the next recession, thinking we can fix it, but finding out we can't.
Silver's recent price movements have been intriguing, showing resilience amidst a volatile economic environment. Currently trading at $29.60, silver has experienced slight losses of 0.04%, largely influenced by mixed U.S. economic data. This pause comes after a significant rally, highlighted by technical indicators such as the doji pattern, signaling indecision among traders. Despite these minor fluctuations, silver's uptrend remains intact. It must maintain its position above the $29.00 mark to challenge the year-to-date high of $29.79. If it breaches this level, it could pave the way to test resistance levels at $32.15 and $35.40. These milestones are crucial for silver's continued upward momentum, reflecting both market sentiment and the underlying strength of the metal. Recent U.S. economic data has played a pivotal role in silver's price dynamics. Mixed jobs and housing data, coupled with a lack of strength in the manufacturing and industrial sectors, have boosted U.S. yields in the greenback. This in turn has exerted pressure on silver prices, leading to its current trading position. However, the ongoing economic uncertainties continue to create a favorable environment for silver as a safe haven asset. 3. GPT. The impact of recent U.S. economic data on silver prices cannot be overstated. The latest jobs report showed mixed results, with employment figures not meeting expectations, which typically would be bad news for the economy. However, this has led to speculation that the Federal Reserve might cut interest rates to stimulate economic growth. Such a move could weaken the U.S. dollar and push silver prices higher. Housing data has also been inconsistent, adding to the uncertainty. While some areas show signs of recovery, others lag behind, reflecting the uneven nature of the current economic climate. This has contributed to higher U.S. yields, which generally pressure precious metals like silver. Despite this, the potential for lower interest rates creates a bullish scenario for silver, as investors seek out assets that can protect against currency depreciation and inflation. Moreover, the lack of strength in the manufacturing and industrial sectors further complicates the economic outlook. With industrial demand being a significant component of silver's market, any weakness here can impact silver prices. However, the overall uncertainty and potential for economic stimulus measures provide a supportive backdrop for silver, highlighting its dual role as both an industrial metal and a safe haven asset.
Looking at what the developed world is doing with its finances and concluding that we got a major currency crisis coming, so that in effect they've lost confidence, like you said. They've lost confidence in the dollar-denominated global financial system, and they're buying gold as protection. And they're buying it pretty aggressively. The world's central banks were net buyers of 1,000 tons of gold in each of the past 2 years. And in a market where the mines only produce 4,000 or so tons, that's a huge new source of demand. And then in the U.S., something is happening that's very interesting at the big box stores. Costco and Walmart have started to sell gold and silver, and now it can be an impulse buy. You can go to Costco and while you're checking out, say, "Oh yeah, toss a gold bar into my basket while we're at it here." And apparently, people are doing that. Costco is supposedly selling $200 million of gold per month, which is a couple of $1 billion a year. And that is a big addition in demand that didn't exist before. So it's clear that this precious metals bull market is linked to a loss of confidence in the global financial system. And to the extent that the central banks are shown to have no tools left to fix their problems. In other words, they have to choose one crisis or another, but they can't choose the path of no crisis, steady organic growth with minimal increases in financial burdens for everybody. That's foreclosed now. We can't do that. We either have to choose a deflationary crash like the 1930s or at a minimum, a currency crisis like the 1970s, but it could be a lot worse than that. So the central banks of the world who aren't in this box are watching the big developed world central banks flail around in there and realize they have no way to fix their problems. And those other central banks are buying gold aggressively. So yeah, I think that gold is being bought by people who have lost confidence in the system. And the higher gold goes, and the more flailing around the world central banks do, the more people will be in that position where they don't like what they're seeing. They're losing trust in the big systems, and they're going to protect themselves with gold. So it's possible that we reach a point in the not too distant future where an awful lot of global capital tries to get through that small door. There's probably 100 times as much investable global capital in the world as there is gold at current prices to satisfy that demand. So let 1% more of global capital flow into precious metals. And you've got, people will be talking about it's not gold anymore, it's unobtainium. You just won't be able to buy it if you decide you want it at that late date, and you'll be wishing that you'd bought some now or bought a lot now. So you kind of want to get out ahead of something like this.
The impact of recent U.S. economic data on silver prices cannot be overstated. The latest jobs report showed mixed results, with employment figures not meeting expectations, which typically would be bad news for the economy. However, this has led to speculation that the Federal Reserve might cut interest rates to stimulate economic growth. Such a move could weaken the U.S. dollar and push silver prices higher. Housing data has also been inconsistent, adding to the uncertainty. While some areas show signs of recovery, others lag behind, reflecting the uneven nature of the current economic climate. This has contributed to higher U.S. yields, which generally pressure precious metals like silver. Despite this, the potential for lower interest rates creates a bullish scenario for silver, as investors seek out assets that can protect against currency depreciation and inflation. Moreover, the lack of strength in the manufacturing and industrial sectors further complicates the economic outlook. With industrial demand being a significant component of silver's market, any weakness here can impact silver prices. However, the overall uncertainty and potential for economic stimulus measures provide a supportive backdrop for silver, highlighting its dual role as both an industrial metal and a safe haven asset.
Where the interest is so high that what you owe goes up even if you're paying it a little bit each month. You're paying on it, paying all you can, but each month the bill gets bigger because the overall balance gets bigger and the interest rate rises if you miss a payment or they decide they don't trust you anymore. So basically they're turning you into a serf. Growing number of people see that, and something called the trust horizon starts to shrink. In other words, in good times, we trust the big systems, and we think the supranational organizations like the WHO and the World Bank and the United Nations are doing a good job, and they're on our side. And we definitely trust the Federal Reserve and the big banks and the federal government. In harder times, we stop trusting those guys because they're clearly not taking care of us, and that's what's happening right now. You're seeing a dramatic shrinkage of the trust horizon of the average person. That's leading them to vote populist and to really put their trust in like local farmers and the guys running their town, the mayor and the city council, because they can meet those people. They can kind of get a sense of who they are, and they can see the results of their policies right there, on Main Street. And when that happens, that changes the political culture in a really fundamental way. Because if you don't trust the congressmen and the senators and the guys running JP Morgan Chase, you are going to take political steps that they perceive to be against their interest. And that's where we got President Trump, really. He's basically a middle finger to the big systems out there that people decided they didn't trust anymore. And you're seeing that all around the world. People are starting to vote for populist candidates who used to be considered fringe. And now they're the second most powerful party in Germany, or the next prime minister or president of France, and possibly the next president of the United States. So that is a political catastrophe for the elites, and they're responding to it with basically throwing the kitchen sink at anybody who opposes them. So you're seeing what used to be kind of soft authoritarianism, where they would lend you money and then you could buy a bunch of stuff, and it was only later that you found out you were the slave of the guys who lent you the money. Well, now they're coming right out with it. They're censoring social media, and they're using the legal system to indict and hopefully, from their point of view, convict politicians that stand in their way. So it's changing political culture from top to bottom. The peasants are no longer trusting of the aristocracy, and the aristocracy has taken the gloves off, and they're just going to impose their will now. So we've got a really interesting, in the Chinese curse sense, decade ahead of us in politics, because it's not clear how this plays out. It's not obvious how the people who are deeply in debt right now are going to get out of debt, and it's not obvious that the elites running the country right now are going to let themselves be kicked out of power and replaced by populists who they don't think understand the world in any meaningful way. So I don't know where this leads, but I think it could easily lead in some really dark directions. And that is what you get when you adopt a fiat currency. You start borrowing incredible amounts of money, you start encouraging regular people to do the same thing, and then those people stop trusting you. This was predictable from day.
Understanding the historical context of silver's price movement provides invaluable insights into its current trends and potential future performance. Silver has a history of dramatic price surges following significant market events, often driven by economic instability, inflationary pressures, and investor sentiment. By analyzing these past patterns, we can better understand the dynamics at play today. Looking back, one of the most notable periods of silver price movement was during the early 1980s, when the Hunt brothers attempted to corner the silver market, driving prices from around $11 to nearly $50 an ounce in a matter of months. This unprecedented surge was fueled by fears of inflation and economic instability, which led investors to flock to silver as a safe haven asset. Although the prices eventually collapsed, this event demonstrated silver's potential for explosive gains under the right conditions. More recently, in the wake of the 2008 financial crisis, silver saw another significant rally. From its pre-crisis low of around $9 an ounce, silver prices surged to nearly $50 by 2011. This rally was driven by a combination of factors including aggressive monetary easing by central banks, fears of inflation, and a weakened US dollar. Investors once again turned to silver as a hedge against economic uncertainty and currency debasement. The current situation bears similarities to these past events, with silver recently breaking its 11-year all-time high and trading at around $29.60. The stage is set for a potential continuation of this bullish trend. Technical analysis supports this outlook, with the formation of a doji pattern indicating indecision among traders, but also hinting at the possibility of a significant breakout. If silver can stay above the critical $29.00 level, it could challenge the year-to-date high of $29.79 and move towards historical resistance levels at $32.15 and $35.40. The silver-to-gold ratio, an important metric for precious metals investors, also provides crucial insights. Historically, when this ratio declines, it signals silver's outperformance relative to gold. Currently, the ratio is showing signs of favoring silver, suggesting that the metal may continue to outperform gold in the near term. This aligns with historical patterns where silver often lags gold in the initial stages of a bull market, but then catches up and often surpasses gold's performance in percentage terms. Another critical factor to consider is the broader economic environment and its impact on silver prices. Inflation concerns are mounting as governments around the world continue to implement expansive fiscal and monetary policies in response to the COVID-19 pandemic and its economic fallout. This has led to increased investor demand for tangible assets like silver, which are perceived as a hedge against inflation and currency depreciation. Moreover, silver's industrial demand cannot be overlooked. As the global economy gradually recovers and industrial activity picks up, the demand for silver in various applications, from electronics to solar panels, is expected to rise. This dual role of silver as both a precious and industrial metal uniquely positions it to benefit from multiple demand drivers. In summary, by examining the historical context and current technical indicators, we see that silver is at a critical juncture. Its ability to maintain and build on recent gains will depend on a confluence of factors, including economic data, investor sentiment, and broader market trends. However, with the right conditions, silver has the potential to reach new highs, echoing past surges and fulfilling the bullish predictions set forth by experts like John Rubino. The stage is set for a potentially transformative period for silver, driven by its unique position in the market.
Yeah, Japan is a good example of where we are headed, and it's really not that far in the distance. Basically, what happened with Japan is that they had their big financial bubble before everybody else. In the 1990s, they had a real estate bubble that was just epic. And so many zombie companies and zombie real estate owners were created by that. In other words, people who bought real estate at ridiculous prices. And then when the prices came back down, they couldn't manage the debt related to that real estate. They were going to go bankrupt. And the government in Japan could have let a whole generation of real estate people go bankrupt and just suffered through the deep, deep recession that would have resulted and come out of it in pretty good shape financially. But instead, they decided to try to bail everybody in sight out. So the government borrowed huge amounts of money, bailed out these zombie real estate companies, and just kept them shambling along for several more decades. And government debt has gone up to a place in Japan where it's as high per capita as any other country has ever seen in human history. And that makes them very vulnerable because their interest rates have to stay very low, or that massive amount of debt, the interest cost on that massive amount of debt, will just eat them alive. And what's happening lately is the yen is starting to fall. See, this was the box that the Bank of Japan was always going to be in, and that the US Fed was going to find itself in sometime later. But right now in Japan, the yen is falling, interest rates are rising, and that combination will blow up the government's finances, because if the yen keeps falling, that's inflationary, and that'll push interest rates up even more, and the government will have to pay so much interest on its debt that it won't have anything left over for anything else. The military, for senior pensions, anything like that. It's all going to go to interest. And that means the government goes bankrupt. So Japan is headed that way at an accelerating rate as the yen falls and interest rates rise. And the U.S. is, because it's making a lot of the same financial mistakes, is headed for that same place where there's no solution to their problems. In our case, it probably won't be the dollar falling against other currencies, because all those other currencies have huge problems too. So the dollar might be relatively strong compared to the yen and the euro and pound sterling, but it might lose purchasing power at an accelerating rate. That's how it would be. Inflation would rise in the US. That would spook lenders who want a higher interest rate on money they lend. So interest rates would go up. And there we are. Interest rates are rising, threatening to bankrupt the government and all the other people in the country that have variable rate debt, while the dollar falls and while inflation increases. And there won't be any way to fix that, because if you try to fix one side of it, like if you try to prop up a falling dollar, in other words, make inflation go away, you got to do that with higher interest rates. Those higher interest rates blow up everybody's interest costs. But if you try to minimize interest costs by pushing interest rates down, then the dollar loses value at an accelerating rate. It starts to become disorderly, the decline of the dollar. And then you've got a financial crisis that points towards hyper.
John Rubino, a well-respected financial analyst and author, has made a bold prediction that has caught the attention of many investors. He believes silver could soar to an astounding $3,000 per ounce. To understand the basis of Rubino's forecast, it's essential to delve into his analysis and the factors he considers crucial for this dramatic rise. Rubino's prediction is grounded in several key arguments. First and foremost, he points to the unprecedented monetary policies being pursued by central banks around the world. Since the global financial crisis of 2008, central banks have engaged in aggressive quantitative easing, leading to massive expansions of the money supply. This trend has only accelerated in response to the COVID-19 pandemic, as governments and central banks have injected trillions of dollars into the global economy to stave off recession. Rubino argues that this relentless money printing devalues fiat currencies, making tangible assets like silver more attractive as stores of value. Another critical element of Rubino's argument is the ongoing inflationary pressures. Despite official statistics often downplaying inflation, many economists and market observers believe that the actual rate of inflation is much higher. Rising prices for goods and services erode the purchasing power of currencies, leading investors to seek refuge in assets that traditionally hold their value over time, such as silver. Rubino emphasizes that as inflation continues to rise, so too will the demand for silver, driving up its price. Rubino also highlights the structural deficits and debt levels in many advanced economies, particularly in the United States. The national debt has ballooned to unprecedented levels, and there appears to be no political will to rein in spending or address the underlying fiscal imbalances. As confidence in the sustainability of this debt wanes, investors are likely to flock to safe haven assets like silver. The historical precedent shows that during times of fiscal and monetary uncertainty, precious metals often experience significant price increases. In addition to these macroeconomic factors, Rubino points to the growing industrial demand for silver. Silver is a critical component in many high-tech applications, including solar panels, electronics, and medical devices. As the world transitions to green energy and increasingly relies on technology, the demand for silver is expected to grow. This industrial demand provides a solid foundation for silver's price, independent of its role as a monetary metal. Moreover, Rubino notes that silver is often undervalued relative to gold. The gold-to-silver ratio, which measures the relative value of the two metals, is currently at historically high levels. Rubino argues that this ratio is likely to revert to its historical norm, meaning silver could see substantial gains relative to gold. This reversion could be driven by a combination of increased investor interest and growing industrial demand. Rubino's analysis also considers the supply side of the equation. Silver mining is capital-intensive and time-consuming, and there has been a lack of significant new discoveries in recent years. As existing mines deplete their resources, the supply of silver may struggle to keep up with increasing demand. This supply-demand imbalance could further propel silver prices upwards. Finally, Rubino underscores the psychological and speculative aspects of the market. When prices of assets like silver start to rise, they often attract speculative interest, leading to a self-reinforcing cycle of buying. As more investors enter the market, driven by rising prices and fear of missing out, the momentum can push prices even higher. Rubino believes that as silver breaks through key resistance levels, it will garner increasing attention, fueling further gains. In summary, John Rubino's prediction of $3,000 silver is based on a comprehensive analysis of macroeconomic trends, historical precedents, industrial demand, and market psychology. While such a dramatic increase may seem far-fetched to some, the confluence of these factors makes a compelling case for significant upward potential in silver prices. As we navigate an era of economic uncertainty, inflationary pressures, and increasing demand for industrial metals, silver stands out as a uniquely positioned asset with the potential for extraordinary gains.
Of traders. In other words, if enough bad stuff comes out, then even the guys who are congenital buy the dip traders will get scared, and they'll pull in a little bit. They'll stop buying the dip. Stocks will fall harder, and then that will validate the idea that things are actually much worse than anybody thinks. And you'll get sell the dip or sell the RIP market. In other words, when stocks go up, people will be very happy to take profits, and that'll give you a bear market at some point. And that's coming because there are an awful lot of kind of under the surface statistics now that point towards a weaker economy, which, that's right, will give you weaker corporate profits and weaker stock prices. And I don't think it's going to be very long before we hit that point, or hit the point of recognition on the part of the markets that that's where we are. Because right now the predictions for the current quarter's GDP is like 1.5% growth versus 3% in some for the previous quarter. So we're already trending down. We've got interest costs spiking for almost everybody that has any kind of debt, which is a thing that slows the economy down. Consumer debt is soaring. We're up above $1 trillion in credit card debt. A growing number of people are carrying ongoing balances that they're paying 20% plus on. So there are a lot of stories like that out there. And in the aggregate, they will give us weaker economic growth going forward. And that normally leads to an equities bear market. So that's what we should expect pretty soon. And it's, as far as that goes, nothing really unusual. That's just the way markets and economies work. And we're probably heading into a down cycle. Now, what happens once that down cycle gets going is where it's interesting. But the fact that we have a down cycle coming, or a downward part of the cycle coming, shouldn't be a surprise to anybody, and shouldn't be anything that really shakes your confidence in your general sense of the world. A recession shouldn't change how you view the overall economy, because recessions just happen. And if we've got one coming, so be it. Trade it. You might want to short stocks or something like that. But it's the Fed's reaction to that recession that's going to tell a big tale here going forward.
Several key factors support John Rubino's audacious prediction of silver reaching $3,000. These factors create a perfect storm for silver, combining macroeconomic dynamics, market sentiment, and industrial demand. Let's delve into these factors to understand why Rubino's forecast may not be as far-fetched as it seems. 1. Inflationary pressures and monetary policy. Central banks worldwide have implemented unprecedented monetary policies, including extensive quantitative easing, in response to economic crises. This has significantly expanded the money supply, leading to concerns about inflation. Historically, silver has served as a hedge against inflation, as its value tends to rise when fiat currencies lose purchasing power. The more aggressive the monetary policies, the higher the potential for inflation, driving investors toward silver. 2. Fiscal deficits and national debt. Many advanced economies, particularly the United States, are grappling with enormous fiscal deficits and mounting national debt. The U.S. national debt has reached staggering levels, raising doubts about its sustainability. As confidence in the fiscal stability of these economies erodes, investors seek safe haven assets like silver. The inability of governments to address these fiscal imbalances further supports the case for a flight to precious metals. 3. Industrial demand. Silver's industrial applications play a crucial role in its market dynamics. It is a vital component in various technologies, including solar panels, electronics, and medical devices. As the world shifts towards renewable energy and technological advancements, the demand for silver is expected to increase. The ongoing green energy revolution, particularly the push for solar energy, is a significant driver of industrial demand for silver. This industrial use provides a strong foundation for silver's price, independent of its monetary value. 4. Supply constraints. Silver mining is a complex and capital-intensive process. In recent years, there have been fewer significant new discoveries, and existing mines are depleting their resources. This constrained supply, coupled with increasing demand, creates a supply-demand imbalance that can drive prices higher. The longer it takes to bring new silver mines into production, the tighter the supply will become, exacerbating this imbalance. 5. Gold to silver ratio. The gold to silver ratio, which measures the relative value of gold to silver, is currently at historically high levels. This ratio typically reverts to its historical norms, suggesting that silver is undervalued relative to gold. As this ratio adjusts, silver prices could rise significantly faster than gold. This reversion is often driven by investor behavior and market corrections, highlighting silver's potential for substantial gains. 6. Economic uncertainty and market sentiment. Global economic uncertainty, fueled by geopolitical tensions, trade disputes, and unpredictable economic policies, drives investors towards safe haven assets like silver. Market sentiment plays a crucial role in precious metals pricing. As fear and uncertainty rise, so does the demand for assets perceived as stable and secure. Silver benefits from this psychological factor, attracting investors looking for stability in turbulent times. 7. Central bank purchases. In recent years, central banks, particularly in emerging markets, have been significant buyers of gold. This trend is expanding to include silver, as these banks seek to diversify their reserves and protect against currency devaluation. Increased central bank purchases add substantial demand to the market, supporting higher silver prices. 8. Technological advancements and silver usage. Technological advancements continue to find new applications for silver. Its superior electrical conductivity and antimicrobial properties make it indispensable in various high-tech and medical applications. As technology evolves, the range of uses for silver expands, boosting its industrial demand. This ongoing innovation ensures a steady increase in silver's utility and market value. 9. Speculative interest and market psychology. As silver prices begin to rise, they often attract speculative interest. This creates a self-reinforcing cycle, where rising prices draw more investors, further driving up prices. Market psychology plays a significant role, as investors fear missing out on potential gains. This speculative interest can amplify price movements, pushing silver to new heights. In conclusion, the factors supporting John Rubino's prediction of $3,000 silver are multifaceted and robust. From macroeconomic trends and fiscal imbalances to industrial demand and market sentiment, these elements combine to create a compelling case for significant silver price increases. While such a dramatic rise may seem ambitious, the confluence of these factors suggests that silver is uniquely positioned to achieve extraordinary gains in the coming years.
Into this and wondering what they should do about it would be just buy some precious metals and then start looking at the other real assets that governments can't make more of and see what kind of capital you have relative to those assets. And if you can buy some more, if you can buy farmland or a homestead or something like that, awesome. Look at what Bill Gates is doing. One of the richest guys in the world is now one of the biggest owners of farmland in the world because he's been buying up farmland with his tech money for the last 5 or 6 years. You want to emulate somebody like that if you can. And then other commodities are incredibly cheap compared to financial assets. So historically, when copper and zinc and silver, if you call it a industrial commodity, when they get down to current levels relative to the S&P 500 to financial assets, they usually take off and have a nice long bull run. So it wouldn't have to be just gold and silver in the commodity space that have big runs. I think copper is a great story, and uranium is a spectacular story. And there are lots of other less well understood kinds of commodities that are going to be very big in what the technological future looks like. So mutual funds that buy critical metals and things like that might be interesting too, or might do really well in a currency crisis. So, there's lots of things you can do. This is an interesting investment thesis. It doesn't have to be the world is coming to the end of its rope. Oh my God, what am I going to do? It's okay. Instability is coming. We're going to see a lot of consequences for our past mistakes. We'll, do a monetary reset at some point. We will fix this problem. But in the meantime, you can profit from all the chaos that's going to ensue if you do this and this and this. And most of the prescriptions, most of the things that you want to do involve real assets that governments can't create more of. So create a commodities portfolio running from physical assets that you own in person out to physical ETFs that go out and buy those commodities, all the way out beyond that to the stocks of the miners, and spread it around cautiously. And, decent chance you'll be in good shape.
Market sentiment and investor behavior are pivotal in understanding the current dynamics driving silver prices towards John Rubino's predicted $3,000 mark. The overall market sentiment towards silver is increasingly bullish, driven by a mix of economic uncertainty, inflation fears, and the metal's historical performance during times of crisis. One of the primary reasons behind the positive sentiment is the growing distrust in traditional financial systems. Economic uncertainty, fueled by geopolitical tensions, unpredictable fiscal policies, and a potential global recession, has made investors wary of holding too much fiat currency. This environment of mistrust propels investors towards tangible assets like silver, which are perceived as safe havens. Historically, during periods of economic turmoil, silver has outperformed many other asset classes, providing a hedge against inflation and currency devaluation. Investor behavior also plays a significant role in silver's potential rise. As more investors recognize the benefits of holding silver, demand increases, creating upward pressure on prices. This behavior is often reinforced by market trends and the influence of prominent financial analysts like John Rubino, who advocate for silver as a critical component of a diversified portfolio. When influential figures make bullish predictions, they can sway market sentiment and encourage more investors to buy silver, contributing to a self-fulfilling prophecy. Additionally, speculative interest in silver has been on the rise. Speculators who seek to profit from short-term price movements have increasingly turned their attention to silver. This influx of speculative capital can lead to significant price volatility, but it also drives up prices as demand outstrips supply. The speculative fervor is further amplified by technological advancements and the ease of trading precious metals through digital platforms, making it accessible to a broader range of investors. The current economic environment also supports the bullish sentiment. With central banks maintaining low interest rates and continuing their quantitative easing programs, the opportunity cost of holding non-yielding assets like silver decreases. This makes silver more attractive compared to traditional fixed-income investments, further boosting its appeal. As inflation expectations rise, the real returns on bonds and savings diminish, prompting investors to seek alternatives like silver. Moreover, silver's dual role as both a precious and industrial metal adds to its attractiveness. Industrial demand for silver is robust, driven by its applications in electronics, solar energy, and medical devices. This consistent demand from the industrial sector provides a strong foundation for silver's value, independent of its appeal as a safe haven asset. Investors are drawn to silver's unique position in the market, benefiting from both economic uncertainty and industrial growth. Market psychology also contributes to the momentum. As silver prices rise, the fear of missing out, FOMO, kicks in, driving more investors to enter the market. This creates a positive feedback loop where rising prices attract more buyers, further driving up prices. This psychological aspect can lead to dramatic price increases, especially if silver breaks through significant resistance levels, signaling a potential bull market. Finally, central bank policies and actions significantly influence market sentiment. In recent years, several central banks, particularly in emerging markets, have increased their silver reserves as part of their diversification strategies. This institutional demand adds a layer of credibility and stability to the silver market, encouraging retail investors to follow suit. The actions of central banks are closely monitored by investors, and their continued accumulation of silver signals strong confidence in its future value. In summary, market sentiment and investor behavior are crucial drivers of silver's potential rise to $3,000. The combination of economic uncertainty, inflation fears, speculative interest, and industrial demand creates a bullish environment for silver. As more investors recognize the benefits of holding silver and influential figures like John Rubino advocate for its inclusion in investment portfolios, the momentum builds, pushing prices higher. The interplay of these factors, supported by central bank actions and market psychology, sets the stage for a significant upward trajectory in silver prices.
When it decides the world is a good place and stocks should go up, it interprets all news as good news. And then vice versa, when Mr. Market is in his depressive phase, all news is bad news. And lately it's been good because you can see that in the jobs reports. The last few jobs reports we've had before this one were pretty strong. And the government was making up the numbers and everything, of course, but you don't find that out until the third revision after the headline. But big headline jobs numbers were coming out, and the stock market would go up on that announcement based on the idea that it meant that the economy was strong and we would have rising corporate profits, and that's good for stocks. So now we get a weak jobs report. And Mr. Market interprets that as, oh, great, the economy is weak and we'll get lower interest rates, which is good for stocks. So stocks are rocking today after that report. And basically, this tells you more about the underlying psychological tone of the market than it does about jobs or the economy or anything. It's just that right now investors have been taught to buy the dip for such a long time that especially when stocks have corrected a little bit as they have lately, they interpret that correction as a buying opportunity. So they look at all news that comes out as validating their desire to buy stocks. And so the stock market goes up on whatever news it is that comes out. So in that sense, the news is not very meaningful, but the tone of the market is pretty meaningful because it tells you what an awful lot of traders out there.
While the case for silver's rise to $3,000 is compelling, it's essential to address the potential challenges and risks that could impede this bullish scenario. A balanced view ensures a realistic understanding of the market dynamics and helps investors make informed decisions. One of the most significant risks to silver's ascent is a potential correction in the broader financial markets. If major stock indices experience a sharp downturn, it could lead to a liquidity crunch, where investors sell off assets, including silver, to cover losses or meet margin calls. This sell-off could temporarily depress silver prices, despite its long-term bullish fundamentals. Such market corrections are unpredictable, but are an inherent part of financial markets, driven by various factors including economic data, geopolitical events, or shifts in investor sentiment. Regulatory changes also pose a risk to silver prices. Governments and regulatory bodies could implement policies that impact the trading and ownership of precious metals. For instance, increased taxes on silver transactions, stricter import-export regulations, or changes in mining laws could affect the supply and demand dynamics. Regulatory changes can create uncertainty in the market, leading to price volatility as investors react to new rules and their potential implications. Another challenge is the potential for manipulation in the silver markets. There have been historical instances where large financial institutions have been accused of manipulating precious metal prices. Such activities can distort market prices and undermine investor confidence. Although regulatory bodies have taken steps to curb these practices, the risk of manipulation still exists and can affect price stability. Macroeconomic factors also play a crucial role in determining silver's price trajectory. A stronger than expected economic recovery could lead to higher interest rates as central banks attempt to curb inflation. Higher interest rates increase the opportunity cost of holding non-yielding assets like silver, potentially dampening investor demand. Moreover, a robust economic recovery could strengthen fiat currencies, reducing the appeal of silver as a hedge against currency devaluation. Technological advancements in alternative materials could impact silver's industrial demand. For example, if new materials are developed that can replace silver in key applications, such as electronics or solar panels, the demand for silver could decrease. While silver's unique properties make it indispensable in many industries today, technological innovation is rapid and can change market dynamics over time. Additionally, silver's price is influenced by geopolitical events. While geopolitical instability often drives investors toward safe haven assets like silver, the resolution of conflicts or stabilization of political environments can have the opposite effect. For instance, improved trade relations between major economies could reduce market uncertainty, leading to a shift away from precious metals. Investor sentiment is another variable that can swing silver prices. Market psychology plays a significant role in driving demand for silver. If investors collectively shift their focus to other asset classes perceived as offering better returns or lower risk, the demand for silver could wane. This shift in sentiment can be driven by a variety of factors, including changes in economic indicators, performance of competing investments, or broader market trends. Moreover, fluctuations in the US dollar significantly impact silver prices. Since silver is typically priced in dollars, a strengthening dollar can make silver more expensive for investors using other currencies, potentially reducing global demand. Conversely, a weakening dollar can boost silver prices by making it cheaper for foreign investors. Therefore, exchange rate movements are a crucial factor to monitor. Lastly, the physical logistics of silver trading can pose challenges. The storage and transportation of physical silver involve costs and logistical considerations that can affect market dynamics. Any disruptions in the supply chain, whether due to political, environmental, or logistical reasons, can impact the availability and price of silver. In conclusion, while the factors supporting John Rubino's prediction of $3,000 silver are strong, it is essential to consider the potential challenges and risks that could impede this bullish scenario. Market corrections, regulatory changes, manipulation, macroeconomic factors, technological advancements, geopolitical events, investor sentiment, currency fluctuations, and logistical issues all play a role in shaping silver's price trajectory. A balanced view, considering both the bullish and bearish factors, is crucial for making informed investment decisions in the silver market.
The broad picture of what's happening right now is that the systems that are in place, in other words, the banking system and the governments of the world and the big corporations, are all over indebted, and they're trying to convince individuals to go into debt in order to increase economic growth, which increases corporate profits, which allows the CEOs of these big companies to pay themselves big year-end bonuses and allows congressmen and senators to get reelected. So they're all very interested in creating a country of debt slaves. Basically, they want to get us as deeply in debt as possible, and in that way control us, and which would be to say keep us in debt for as long as possible, paying really high interest rates and late fees and things like that to prop up the profits of the credit industrial system. A growing number of people are starting to figure out that that's the game. You know, they're working hard, sometimes at 2 or 3 jobs. They're still not quite making ends meet. They're having to go into debt to pay the basic bills. You know, not even for nice vacations and big cars anymore. It's you're feeding your kid by putting it on plastic. And a growing number of people are starting. You're seeing it in polling, where pollsters go out and ask people what they think of the economy, and a growing number of people are saying the economy is trash. It's really bad. My life is much harder, and that is deeply confusing to the establishment. You'll see somebody like Paul Krugman, or basically any major politician out there now, saying people are just ignorant. They don't know how good the economy is, and the reason people see more clearly than these politicians and economists and New York Times columnists is that those guys, the elites, are doing just fine. They're making plenty of money. They're paying their bills with no trouble. Their stock portfolios are going up. So to them, the economy is excellent. But to a growing number of people who aren't in that 1%-ish class, it's getting harder and harder to pay the basic bills. Debt is piling up, and they don't see any way out of it. Because, once you've got credit card balances that are charging you 25%, there really is very little way out of that, because the credit card balances will grow faster than the average person who built those credit card balances up in the first place is able to pay them off. So it's like being locked into a relationship with a loan shark.
To sum up the reasons behind John Rubino's bold prediction of silver reaching $3,000, it is crucial to consider the interplay of several factors, both economic and technical, that contribute to this scenario. First, the current economic landscape is highly conducive to rising silver prices. Central banks' expansive monetary policies, particularly in response to the COVID-19 pandemic, have led to a significant increase in money supply. This monetary easing raises fears of inflation, driving investors towards tangible assets like silver, which historically serves as a hedge against currency devaluation. The continuation of these policies supports the bullish outlook for silver. Second, fiscal imbalances and national debt are reaching unprecedented levels, especially in the United States. The staggering amounts of national debt raise concerns about the sustainability of current fiscal policies. As confidence in the government's ability to manage this debt wanes, investors increasingly turn to safe haven assets like silver to preserve their wealth. This shift in investor sentiment is crucial for driving up silver prices. Third, silver's dual role as a precious and industrial metal uniquely positions it to benefit from multiple demand drivers. Industrial demand for silver is robust due to its essential applications in electronics, solar energy, and medical devices. The green energy revolution, particularly the push for solar power, is a significant driver of demand for silver. This industrial use provides a solid foundation for its value, independent of its monetary characteristics. Fourth, the historical context and technical indicators strongly support the possibility of a significant rise in silver prices. Technical analysis shows that silver has broken through critical resistance levels, and the formation of bullish patterns suggests further upward movement. Historical price trends indicate that silver often experiences substantial gains during periods of economic uncertainty and inflationary pressures. Fifth, the gold-to-silver ratio, currently at historically high levels, indicates that silver is undervalued relative to gold. This ratio typically reverts to its historical norms, suggesting substantial potential for silver to outperform gold. As this reversion occurs, it is expected to drive significant gains in silver prices. Sixth, market sentiment and investor behavior are increasingly bullish towards silver. The growing distrust in traditional financial systems and the search for stable investment options amid economic uncertainty propel investors towards silver. Speculative interest, driven by the fear of missing out, FOMO, creates a self-reinforcing cycle that can push silver prices higher. Seventh, central banks' actions, particularly those in emerging markets, support the bullish case for silver. These institutions are diversifying their reserves and increasingly accumulating silver, adding substantial demand to the market. Central bank purchases signal strong confidence in silver's future value and encourage retail investors to follow suit. Eighth, technological advancements continue to enhance the industrial demand for silver. Its superior electrical conductivity and antimicrobial properties make it indispensable in high-tech and medical applications. As technology evolves, the range of uses for silver expands, further boosting its demand and market value. Finally, addressing potential challenges and risks is essential for a balanced view. Market corrections, regulatory changes, and economic shifts can pose significant risks to silver's rise. However, the combination of strong macroeconomic factors, historical precedents, and growing industrial demand creates a compelling case for silver's extraordinary potential. In conclusion, the confluence of these factors, expansive monetary policies, fiscal imbalances, robust industrial demand, historical trends, technical indicators, bullish market sentiment, central bank actions, technological advancements, and a balanced view of potential risks, strongly supports John Rubino's prediction of $3,000 silver. As we navigate an era of economic uncertainty and inflationary pressures, silver stands out as a uniquely positioned asset with the potential for extraordinary gains. The age of silver may indeed be upon us, presenting a unique opportunity for investors to benefit from its remarkable ascent.
Things would go much better and much more smoothly as we progress from, the breakdown of the current fiat currency system to some kind of a monetary reset where we go back to a gold standard or whatever, if we have the right people in charge. And those people would probably be the guys we consider now to be populist. Corporate Democrats and country club Republicans are not going to fix this because this is their gravy train. They're making money from this. So they're going to run this thing right to the very end because it's their job to do that. So politically, I don't want to get people's hopes up and think that one election is going to change things in a way that gives us some kind of utopia, because that's not going to happen. There's going to be a gigantic crisis involving all the debt that's been taken on. But that's not to say our votes don't count, because if we elect the people who are mistrustful of the current system, that's going to be very messy, but we'll have the right guys fighting for us. So you never want to fall in love with any political philosophy or any individual politician because they will break your heart. But generally speaking, if you look at people like libertarians and populists, that you'll have a better chance of getting somebody who, by and large, on balance, does things that work in your favor than if you just go back to business as usual. You know, if you elect the Clintons or the Bushes again, or their cronies, put them back in power, or keep them in power, nothing good is going to happen. And one of the big reasons, one of the big differences between today's populists and today's elites is that the elites make money from war. The military-industrial complex basically decides where we should invade next. We go do that. We destroy the economy and the military of whoever we're invading. They have to rebuild by buying new weapons. We insist that they buy weapons from General Dynamics and Raytheon. Raytheon and General Dynamics then contribute to the political campaigns of the guys who started the war. That's a cycle that it risks destroying the human race if we don't stop it. So politicians that are at least rhetorically anti-war are definitely a better bet than the guys who are saying, "Oh yeah, we're the United States of America. We can fight 3 wars at the same time. Easy. We're the most powerful country ever." You know, when you hear that kind of rhetoric, you know that guy is trying to enrich himself at your expense and at the expense of all the people that the military kills. So look for people who want to pull out of as many wars as possible. And, I'm not saying Tulsi Gabbard will ever be president, but she's a politician who mostly says the right things about the forever wars. You know, she runs against Afghanistan and the Second Iraq War and the Ukraine War. And, if you can find people like that to vote for, that gives you a slightly better chance of having honest people with your interests in mind in charge as we go into all the chaos that is basically inevitable.